Hello and welcome back to another episode of Supercharge Your Finances, the financial education video series. My name is Easton Price, a financial planner with Prosperity Wealth Planning, and today we're going to be covering Social Security and when you should claim. Social Security is one of the largest retirement income decisions that most Americans face. And filing too early or too late can mean tens or even hundreds of thousands of dollars of difference over your lifetime. So it's a big time decision. And what we'll be covering today are the basics of claiming ages, what factors actually matter when considering what age to file, and then how we use planning tools to help clients decide. So with that, let's jump right into the basics of claiming ages. Now on this bar graph, you're going to see three highlighted columns, one at age 62, one at age 67, and one at age 70. The reason why these are specifically called out is because these are the three most common ages in which folks claim Social Security. As early as possible, age 62. Most people's full retirement age is age 67, and the latest you can wait to claim is age 70. I've shown these other years just to give you an idea of what happens if you decided to claim at age 63 or at age 69. And so with that, your full retirement benefit or full retirement age right here for most Americans age 67, we have what we call the primary insurance amount, which is based on this big calculation of your working years and compensation over those years. Very specific formula the Social Security Administration uses that we won't dive into for this video, but for illustrative purposes, age 67 is that full retirement age. That is where you are eligible for 100% of your primary insurance amount. And in this example, we're going to call that amount $3,000. So what happens if you claim as early as you can at age 62? Well, you're going to see a slight reduction in benefits every year that you claim. So from 100 down to 93 to 86 to 80, 75, and ultimately 70% of that primary insurance amount, 3,000. So if you claim as early as you can, age 62, what that means in terms of dollars based on that $3,000 amount is about $2,100. Now, on the flip side, instead of reducing your benefits, every year that you delay your benefits past your full retirement age, you get an 8% increase of your benefits, plus whatever cost of living adjustment is happening to the baseline amount of $3,000. So in this case, that $3,000 primary insurance amount waiting 1 year to age 68 would be increased by 8% to 3240, by another 8% to 3480, and by another 8% to 3720 would be the max amount you could claim at age 70. Again, this ignores the cost of living adjustment on that primary insurance amount, but that would also be factored in. So very important decision when claiming Social Security. And there's a lot of arguments that say, well, I should take it as early as possible because that means the most amount of time that I'll have the Social Security benefit. Others say, well, let's maximize the benefit and get as much out of it as we can, and so let's delay it until age 70. And others trying to find a happy medium, and that's where they fall into the full retirement age. So what's right for you? Well, really, what it comes down to is it's a longevity issue. Do we have a tendency to live to certain ages? Do we have some sort of cancer or disease that is hereditary that might limit my lifespan? And so it's really a longevity issue. It's also an income needs issue. Is there an immediate need for cash flow when I retire? Or are there other investments inside your portfolio that you can use to supplement your lifestyle until you turn those Social Security benefits on? And the third item on the list here is spousal coordination. This is really important, especially for the higher income earner whose Social Security benefits are going to be higher. Whatever election they make will not only have an impact on the benefits they claim, but if they do predecease their spouse, will also impact the benefits that their spouse is eligible to receive upon their passing. Fourth are considerations for taxes, and we'll talk about that here in just a minute when we dive into our financial planning software. And lastly are the portfolio implications. Again, that argument of if I claim earlier, yes, my check is smaller, but it's a longer amount of time that I get to claim it versus waiting, getting a bigger check, fewer years claiming your Social Security. But what does that actually do to your portfolio? And we'll talk about that here in just a minute as well. So with that, I'm going to go ahead and exit this. I'm going to jump over here to our financial planning software. So here are Homer and Marge Simpson. And I'm going to use them as our sample clients for today's purposes. And remember, this is just for illustrative purposes. Your situation could look totally different. I'm going to show you three scenarios. One where they claim at age 62, one where they claim at age 67, and one where they claim at age 70. One of the first considerations we need to make is around cash flow and income needs. Both Homer and Marge have already identified that longevity is not really a huge concern. They both plan on living into their 90s. And so that's what we've got their lifespan planned out to, about age 92 for Homer and age 94 for Marge. So for their income needs, we can jump in here and actually see how long they plan on working. And for each of them, Homer, he's going to work till age 62, and then Marge, she's also going to keep working until she's age 64. So what does that mean from a Social Security standpoint? As you can see here, they're currently age 52 and 54. They'll continue working until age 62 and 64 respectively. And so if Homer begins claiming Social Security here at age 62, because of the earnings adjustment, and Social Security Administration calls it the earnings test adjustment, which you can see over here in this fourth column. Because they're still working and their salary is going beyond age 62, if they were to claim their Social Security benefits starting at age 62, the earliest if possible, the earnings test adjustment would actually mitigate all of the Social Security benefit and exempt them from claiming any of those benefits. The entire $28,000 would be exempt from their income. And you can see that continues to happen until they reach full retirement age for Homer, age 67, and then for Marge down here at her age 67. At age 67, that full retirement age is where the earnings test adjustment goes away completely. So that's the first scenario I wanted to show you there at age 62. Next, I want to kind of jump in and show you a side-by-side comparison of what happens if they claim at age 62 versus age 67 versus age 70. So their annual cash flow comparison here at current strategy, which is assuming age 62, you'll notice that it actually won't go back to age 62 because of that earnings test adjustment. Because they're working to age 65, neither of them will be eligible for benefits at age 62. So they have to wait until age 67. And if we compare this to their full retirement age, so age 67, to claiming at age 62, what we'll actually see is a difference of almost $500,000 of additional income over their lifetime from waiting to claim at age 62 to claiming at age 67, because again, that benefit is increasing. They're receiving 100% of their full retirement age benefit, that primary insurance amount, versus reducing that benefit permanently by claiming at age 62. And this is one step further. If we claim at age 70, almost $1 million more from waiting until claim at age 70 versus claiming at age 62, because now you've got your 100% of your primary insurance amount plus 8% every year that you wait. Another way to look at this is, what's the break even here? A lot of people will say, well, if I wait until age 70, how long do I have to live for it to make sense for me to have waited until age 70? And this is going to be different for everybody. But for Homer and Marge specifically, their situation is such that age 77 is that break-even point to where it would make sense for them to wait until age 70 to claim their benefits. So for them, again, they've identified that longevity is not an issue. They might wait until age 70 to claim benefits because that break-even is not super far out in the future, just another 7 years. I cannot reiterate this enough. This will look different for everybody. So don't assume that age 77 is your break-even age. This depends on income, this depends on portfolio, and a number of other factors. So bringing it all together here, how Social Security claiming age changes your lifetime incomes. There are three metrics I want to focus in on: total lifetime income, total lifetime taxes, and total portfolio withdrawals. Your total lifetime income at age 62, that's our base case. So that's why this 100% is showing there. Beyond that, waiting to age 67, you actually increase that by almost 9.5%. And then by waiting to age 70, you increase that almost 17%, 16.7%. So your total lifetime income, as expected, only increases for every year that you wait to claim Social Security. Again, one thing I want to highlight here, this is illustrative purposes only. This is just using Homer and Marge's scenario. For total lifetime taxes, again, same story. More income means more taxes. But we actually see this break even to where it makes sense for them because they've delayed their Social Security income and the timing of their other incomes, that their taxes actually drops from their age 67 to their age 70 scenario. And lastly, portfolio withdrawals. It's the same exact scenario across age 62 and 67 because of the earnings test adjustment that we talked about, but total portfolio withdrawals actually drops almost 6%. Because we're waiting to claim, yes, we have to supplement our earlier years of retirement with our portfolio, but because we're maximizing our Social Security benefits by waiting to age 70, we're growing that Social Security check and thus reducing their total lifetime portfolio withdrawals for Homer and Marge Simpson. Again, illustrative purposes only. Happy to show you what yours would look like using your details. Lastly, here's some common pitfalls. Filing early just because everyone does. Context matters, and your situation is different from your neighbor's situation. So understanding your numbers and your goals is of utmost importance here. Ignoring spousal coordination, again, especially for the higher income earner, it's really important to consider not just your benefit, but what that means for your spouse. Only focusing on break-even math, you've got to take the whole situation into consideration. Not considering taxes with that earnings test adjustment specifically, and then making decisions without a full retirement plan. Ensuring that you're taking into consideration your future goals and your future plans, that will help you make the decision of when should I claim Social Security. Really appreciate you tuning in today, and if you want to dive deeper on your Social Security benefits and when you should claim, feel free to reach out to us and we'd be happy to take a look and run the numbers for you.
Past performance is not indicative of future results. Investments involve risk and, unless otherwise stated, are not guaranteed. Prosperity Wealth Planning, LLC is a registered investment advisor located in Irvine, California. Prosperity Wealth Planning may only transact business in those states in which it is registered or qualifies for an exemption or exclusion from registration requirements. The information in this video should not be construed as a substitute for personalized individual advice from Prosperity Wealth Planning. Information is for educational purposes only and is not intended to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Prosperity Wealth Planning is not a CPA firm or law firm and does not provide specific tax advice, legal advice, or estate planning services. You should consult with a qualified tax professional or attorney for tax or legal advice before implementing any strategy discussed herein. The opinions expressed by our firm or its supervised personnel herein are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions, and may not necessarily come to pass.